whether there's a market for chips, whether they're potato chips or electronic chips. And if the market isn't there and I build my factory, I'll lose my shirt. But that's even more so if I've borrowed to build that factory. Then I'm using this fictitious money. I'm really hung out to dry if I don't make any money on my chips. Monetary returns. Okay. Where does profit come from? Well, industrial capital, we talked about it. Profit comes from surplus value, garnered from labor or from nature, however you want to look at it. And financial capital also makes a profit. But where does that come from? Well, it also comes from the same pool of surplus value created by the real economy. So ultimately, financial profits have to come out of the real economy. They aren't just invented out of whole cloth. Now, in the short run, it may seem like they're from whole cloth. But in the long run, they can't be. So in a sense, the financial profits are kind of secondary exploitation, where you loan money at interest to the real economy, and the price of that loan that people pay to get that credit is the interest rate. So they have to pay that back to the money owner. Or I simply own a corporation. The corporation makes money. I just clip my coupon. And there's an English called these rentiers. I just clip my coupons, and I walk off with a portion of the total national income. Yeah.
Going back to financial capital, just tease out a little more what you mean, or what you aim to surplus value as in derivation of profit.
Well, I mean, look, if I lend to a real company, I'm a financier and I lend to an industrial company so they can build a factory, I get a cut of what they make, which comes as an interest payment. But I get my cut because I lent them my money, which came to me simply because I have money. In the same way, they get a cut of what the workers produce, simply by virtue of owning the means of production. So that's what I mean. Now, and of course, there's all kinds of ideological explanations about why I did them a service and why they owe me a cut. But in the end, the reason I get money is because I have money. And those who have money, it takes money to make money. If you haven't got it, you can't lend it and you can't make money off of it. So it's kind of a weird thing in which people who have wealth can make more wealth simply by handing you, the worker and the producer, money. And this, of course, is the source of why there's always been a lot of criticism of financiers for exploiting the real producers. Yeah.
So kind of also going on about that. So when the loans don't realize into future profits based on real economic activity,
then I, the financier, take a bath. I lose my money. Right.
So, but it's
and that's called risk.
Paper money, the kind of fictitious.
Yeah, but I made it up and I still eat it. So if I do too much of that, my bank gets into trouble.
Right.
You get a bailout, right? Yeah, so true. And asset values are another kind of, money making money. Another way that money makes money is simply by investing in paper assets. And financial capital does a lot of this. So financial capital can lend or it can invest in paper assets. And a lot of what goes on in the financial world, as I will continue to say through this, is simply investing in paper assets. It's not actually creating anything. Now, maybe stirring the economy in certain indirect ways, but it's not actually making anything, which is why ultimately having a financial sector that grows from 10% of your economy to 28%, as it did in our economy, is a danger sign, because it's not doing anything much. Okay, so what determines asset values? I mean, they do invest in paper assets simply to be coupon clippers and get the dividends or the interest, but they're also investing in the idea that values will go up. So if values go up, I can sell my stock for more than I bought them, and that's what most investors are doing, right? Buying in order cheap to sell dear. It doesn't create anything. What determines those values? Well, supply and demand of the asset, and behind it, the growth of the real economy that those assets represent. But what financiers are doing is betting on asset value. They can bet on them going up, or they can bet on them going down. When they bet on them going down, it's called hedging. When they bet on them going up, it's just called, I don't know, there's no word for it, it's just investing. And the profit comes from the change in value. What is speculation? Well, speculation is always a bet on the future. But in this case, it's a bet on the future value of paper assets. Okay, let's get to banks and securities. It's a little more straightforward. So it won't take as long to go through it. Okay, banks and money, banks and credit, bank services, bank regulation. Okay, banks and money. Banks are money handlers. That's what they do. And they provide a basic, you could call it a service, except you know that word. We don't like that word very much because it's really misused. So what banks do is they handle money. They accept the money put out by states. They accept money put out by other banks. I guess I should have said that, sorry. They accept all kinds of other people's monies. They're dealers in money. And then they keep accounts. And they keep those accounts as virtual money. They're just these numbers on a page or electronic signals in a computer. They provide money. Okay, so they take in and out money, but they provide money. And that is, they've got these virtual accounts. But if you need cash, you go to your ATM or you go to the teller and they give you state money. They give you something very tangible money out of your virtual account. So they are money providers. And they do that in various forms. It can be cash, it can be checks, it can be plastic. Those are the bank forms of bank money. So those are all, checks and plastic are bank money. Currency is government money. And banks handle all of those. They're money creators. They're not just providers. They're not just handlers, but they actually create money, as I've said already. That is, they give you checks, which you can write, which are just the banks. They're all, it's on the bank's good credit. When you write a check, you may have the money in the bank, which means you think, okay, right, this check represents real money that I've got. In fact, there's no money in the bank. The bank isn't sitting on a pot of money in your account. It's nothing but an accounting device. But the check still clears. So they're creating money. And when they loan, even more so, when they provide a loan, as I just said, they create new money. They're also creating new money when you use your credit card. Now, when you use your debit card, they're not creating new money. They're simply turning your money of account into cash money at the store. And then they charge you for that service. If you're using credit card, you don't have to pay that credit for what, a month, 2 months, whatever it is. Let's say a month. That money doesn't yet exist in your account. It's going to be charged to you, and you're going to pay it off out of your real account, where you think there's real money. So it's all creating new money. And they're doing this all the time. Now, banks circulate money. So money is going in and out of banks all the time. And when I get an account, what I'm doing is actually just getting a place. It's like plugging into the electric grid. I've got a plug, I stick my computer into it, and it suddenly lights up. Okay? That's what I'm doing. I'm getting access to the bank system through my bank account. I have the right to go into that bank, do business with them, have them deal with my money. And the money circulates through the accounts. That is, I can deposit money in my accounts, I can take money out of my accounts, and I can leave a savings balance in my account, which is a stock of my money. Except, again, it's not really there. Now, banks are infrastructure in that sense, you see. They're circulating money, they're putting out money. They're just like your water system. They're just like you spend money. I turn on the tap, the money comes out. And that's what I do when I go to the ATM, is I turn on the tap and the money comes out. And most of what banks do in that sense, as a basic infrastructure, is just no different what the electric company does. They provide this kind of collective infrastructure that allows money to move around. I can get at it and so on. Same thing with electricity. Now, the electricity is actually there, but as you know, the generator is just humming away down at the power plants at Morro Bay or wherever it is, goes into the grid, and it waits for you to plug into it. It doesn't, you don't have to call up the power plant and say, hey, could you turn it up a little for me? No, you just plug in. Same thing with the banks. Money is flowing, they're creating money, and you just put in your little plug and get your money. Okay, commercial banks are giant corporations. The basic kind of bank in America is called a commercial bank. And they have their corporations, they have branches all over now. There's behind them, and a branch system is a system by which many small local offices of the bank can be providing this bank services, this money services, and the parent bank is moving the money around between branches. That is, they all plug in. They're just like bigger faucets. They're like hydrants in the overall giant water system. Then there's an interbank system where banks clear checks and virtual accounts all the time. As checks are moving around, as money is moving around, the banks have to move money from one to another to deal with the fact that all the personal accounts and business accounts are not in sync. So you're writing a check from Wells Fargo to Bank of America. Bank of America has to present it to Wells Fargo pays Bank of America. That's called interbank clearing. And there used to be, now checks are diminishing, but there used to be whole buildings, and I forget what this is one, but there are whole buildings in big cities that are virtually devoted to giant machinery clearing checks. Billions of these things a day. Because again, there's many more of them than there are even of cash dollars. And then there's a Federal Reserve System, which is the bank to the banks. And the Federal Reserve System is where the banks have an account. They store a little extra reserves they have to keep with the Fed for a rainy day. And then if they get in trouble or they're short one day or 1 month, they go to the Fed and say, could you give me a loan? And the Fed gives them a loan. And the Fed, therefore, backs up the whole bank system and also guarantees the bank system and also keeps the bank system liquid. Yeah. Yes, they are. Yeah, instead of this, what you're getting is server farms. Yeah, I guess I should have said that. Yeah. Now it's, I always loved check clearinghouses because they have these giant machines. It's like the mail sorting rooms. You know, they got these giant mail, post office things like down at Albany Point there, whatever it's called, Point Isabel, that it's just clearing packages and letters through these machines. They read them. Well, that's what these checks. That's why all those codes on the check, so the machines can read them. So I love that. But now it's all computerized and boring and you can't see it. But I think seeing it kind of made it still tangible. Okay, banks and credit. All right, banks lend. The business of banks is lending. That's what banks do besides simply being water faucets, money faucets. They have this additional function that's extremely important, which is lending. And indeed, when you look at what are the assets of a bank? Now, the assets of an oil company are its oil wells and its refineries. The assets of a bank are its loans. Now, it has some savings accounts. It has some reserves. But those reserves are no more than 10% ever of its total assets. So much more of the bank's assets are in loans, which are basically new money. So banks are in the business of creating new money. Now, they do recycle old money. I put my money in the bank. I deposit my check from UC, which I suppose is still good. And then the bank can take my money, and those banks will take my money and lend it out. But then most of what they do is lending out new money, not just old money. So banks are this absolutely basic part of the financial system, of the credit system, creating business and consumer loans to keep the whole process of production and consumption going and expanding. They're providing this basic money for ongoing expansion of the system. And, of course, they do it to make money. They make loans because they get interest. And in the old days, bankers, that's what they did. They made loans and they got interest. Now, the problem we'll see is they got into funny money, they got into the capital markets, and they stopped doing just that basic function. And when they forgot what their basic function was, is when the banks got into huge trouble and caused us huge trouble. Business loans are, of course, creating new capital for investment and are essential for growth. And we'll discuss growth. No, it's not lecture 18, it's lecture 19. Sorry about that. And there's also banks handle bridging loans or commercial loans to help out business settle its accounts at the end of the month when they have cash flow issues, which they always do. Consumer loans, again, are one-time loans for making, I'm repeating myself, but I think this stuff needs some repetition. That one-time loans to buy a major product like a house or a car. Those are the two major loans for individuals. And the third kind of loan is sort of equity loan against your house to send your kid to college or whatever, which more and more you need. Now, obviously, college loans are kind of one-time loans in the sense that you get them for the year or you get them for the semester. Whereas a credit card is a kind of right to make little loans all the time or to get little credit all the time. And all credit cards are issued by banks. Visa does not issue credit cards. It has an office over in San Mateo or in Foster City where it manages this whole worldwide system. But every credit card you get is issued by a bank. And it's the bank that's giving you the credit. And then interbank loans are settling these day accounts. Nobody ever pays any attention to the LIBOR rate, the interbank rate, which is extremely small. But when you get a crisis, then it goes, here's 2008, and here's late 2007, it peaked 2008. It went down, right? This is the base spread. 3 month and the spread. Yeah, the spread went up and short term was getting very expensive. Then it got very cheap. Then it got very expensive again. And that's when the credit markets, the interbank credit markets just about closed down. They're overnight, yeah, mostly overnight. And nobody pays any attention. They're absolutely automatic. Nobody cares, except, as you can see, every time there's certain financial issues, it'll shoot up. And those are signs. This is 07, a couple times in 07, a lot of insecurity, and then in 08 it shot back up again. That only goes through, that only went through April 08, so it's not very helpful because it ends up going way up here and essentially freezing the interbank markets for about 2 weeks when everybody thought the world banking system would collapse. Because banks wouldn't even trust other banks. So mostly banks, again, are just operating as this infrastructure. And it's like the crisis, if you get an earthquake and the water pipes break on the aqueducts coming from the Sierra, then you notice your faucet may not do anything. Otherwise, you never notice, right? You just turn it on, brush your teeth, you never think about it. It's only when it breaks down that you think about it. Okay, bank services. Banks have tried to market themselves as providing products, but money is not a good or service. Okay, going back to the last lecture, money has nothing to do with real goods and services. It is money. It is a representation of value. It is a measure of value, all that stuff. Banks have tried to commodify banking to get you to buy more bank services, bank products, and then they charge fees for what they do and say, well, you got to do that because I'm giving you a service. But, of course, the whole question is, how much is that service worth? How much should they be charging you? And when Bank of America proposes a $5 charge on using your debit card, people go, are you kidding? I stick my piece of plastic in there, and I got to pay $5, maybe 5 cents. That would probably be way more than the cost. Maybe 0.005 of a penny might be correct. Yes. Yeah, no, there's so much protest they turn back. So again, like all prices, remember when we talk about labor markets, prices can be negotiated too. And bank fees are absolutely something subject to regulation and public dispute because it's money. It's the cost of money. And you can tell, well, the market sets it. Does the market really set it? Is there no wiggle room? There's plenty of wiggle room. Yeah.
So you're saying that charging a small amount is still, it makes sense. So are banks providing a service with their infrastructure?
Right.
It's an ATM service.
Right, but if you look at East Bay Mud, they charge you for the water, right? And they charge an extremely low rate. Most people don't even think about their water bill unless they're watering in the summer in Danville. Then they start to notice it. But most people, you never think about it. If you live in an apartment, whatever, a few tens of dollars a month. Because it really doesn't cost that much to provide the water. Now, it doesn't cost banks that much to provide the money to do what they do. But somehow banks get much richer than the water company, as you may have noticed. Now, PG&E would like to be as rich as a bank, and they sometimes have played this game. But they're under the Public Utilities Commission, so that also has restricted the fees that they could charge, the rates they could charge. Except then we deregulated PG&E, got more independent, and all hell broke loose, and the rates and the whole thing went crazy. And so then they decided not to check their gas pipes because they weren't making enough money. But the banks wouldn't do that, right? They would check their ATMs because they wouldn't make any money if their ATMs blew up. Yeah.
So the service that the water network paying for is so cheap because we're commodifying a natural resource.
Well, it is that, but it's also because it's a collectively provided thing in the water. Yeah, you could argue it should be more expensive. But you don't see water companies, become huge international institutions. Now, there have been some attempts in recent years to marketize, privatize water and make it a big thing. They've almost all fizzled. Right. Because why? Because people in Bolivia, they're about to be charged by Bechtel for water, go ballistic. Because water's so basic. Well, banks should be that way too, but in fact, banks get very, very rich, become global institutions. You go, wow, banks, those are really important. Why?
But wouldn't the price of water go up if you would allow people to be competitive in that market? It would automatically drive the price.
Or you mean non-competitive?
Yeah.
Depends. Yes, in the back. Yeah, that's a rent. Rent. Yeah, no, that's reasonable too. To have the plug at your house, have the wires coming in. So yeah, the bank can charge you for the account. Basic account fees don't make a certain sense. Now, in fact, they take your money and they invest it and make money on your money, and that's usually more than enough to pay them for the cost of keeping your account. But they like to charge extra in addition because it's all about their profit and loss statements and what they consider an appropriate competitive rate of return. But there's no reason you can't have banks making 1% per year. Now investors would stay away from them. But okay, so then make them all community banks. Just turn it East Bay Mud, East Bay MUB, Municipal Utility Bank. Why not? I mean, there are, of course, credit unions that do exactly that and make very little money. And they stay small. And they just give you your money, take your money, and that's all they do. And give you a loan every so often if your credit's good, which is basically what banks should do. Bank fees, the banks took a huge hit in the late 70s, in that crisis, 80. They took a huge hit in the 80s for reasons that have to do with the shift to securities more than anything else, but also because they took some big losses in the crisis of the early 80s. So their profit went way down. And then they slowly got it back up to huge heights in the 1990s. And a lot of that was built on, two things, getting into securities investments, and secondly, jacking up their fees and their interest rates. Yeah, no, I got to keep going. I'm running out of time. Bank regulation. Okay, bank regulation just means there's a basic oversight system. You can have charters for banks by states or by the feds. They have to do their accounting and report on audit, just like any public corporation. So banks all have to do these things. There's no bank that doesn't have to report. There are hedge funds that don't, but there's no bank that doesn't. And there are agencies that oversee. Every state has a different one, and then the U.S. Treasury Comptroller of the Currency is the agency that oversees the banks. And they're supposed to look at the accounts, look at the balances, look at any skullduggery, and just make sure it's all clean, which of course they forgot to do for the last 20 years. Now, just a quick history of American banks. The Jacksonian system dominated in the 19th century, where we had state-chartered banks, no national bank, because Jackson abolished the second bank of the United States, and the Jeffersonians abolished the first bank of the United States, both in the first half of the 19th century. So we ended up with the most decentralized banking system in the world, which still worked. We had little bitty banks all over the country. You couldn't go beyond the border of a state, and yet the United States grew like crazy. Another sign that you don't need gigantic banks. We got nationally chartered banks after the Civil War, but they still had to operate within the state. So something like First National Bank of New York became Citibank. And a lot of banks were called the First National, Second National, something like that. And then in the 20th century, we got branch banking, because in the 19th century, you couldn't have but one bank. We had Bank of California in San Francisco. That was